The beauty about indexing is you never miss an Amazon or an Apple. And the bad thing about indexing is you never miss having a lot of overpriced stocks into one of the relatively rare bubbles, such as we have now. So it's kind of good news, bad news. If you can ride out the odd 50% decline, totally unnecessary, of course, on fundamentals, as Schiller pointed out 30 years ago. The market is mildly hysterical from time to time, and it's totally unjustified by the steady stream of dividends and earnings. But it happens. And if you want to ride those 50% drops, good luck. It works out very well in the long, long run. But it can take you 20 years to get back in the game. If you get caught in 1929, it works out just fine, but you don't get your money back until 1955. If you get hammered in 74, you don't get your money back until 87. And then when you've gotten it back for a month or two, you give it up again. And the same in 2000. By 2010, you're still losing money. So you have to be willing to ride out. And some people feel their lives aren't long enough to take the odd 10, 15, 20-year wipeout. So for those who feel they're brave enough and willing to try, I've always thought that sidestepping some of the pain might be a good idea. I think they're perfectly straightforward. They're intellectually easy and psychologically disastrously difficult. They're easy because in most cases, they're so extreme. It's like, how do you notice the Himalayas when you're standing in northern India? I mean, they come out of the plane and they soar up. You can't miss these things. 1928, 29 was just such a massive rally. So the sheer price rise, you can't miss. Secondly, just to make it easier, the great bubbles have always tended to rise faster and faster towards the end. And that's a kind of defining feature also. And then thirdly, they have all been accompanied by massive, public, obvious, crazy behavior, where the headlines migrate from the financial page to the front page, where they migrate to the opening few sentences of the evening news on the radio or the television. And they talk about market new highs, and they talk about what the Bitcoins of the era have done. I know it's not a stock, but it's a speculative instrument, and the GameStops of the world. And back in 2000, most of you will be old enough to remember the pet.coms and the utter craziness of that period. And the same was true of 1929. The same was true of Japan. We had a group from Salomon Brothers, a leading American brokerage house of the era, who came around in 88, 89, when Japan was moving to 60 times earnings, and explaining that their yields, et cetera, and their interest rates, et cetera, they really should have been selling at 100 times, and they were cheap, and you should buy them. And it didn't stop the Japanese market breaking the following year. It has not recovered the high of 31 years ago yet.
So it's one thing to call a bubble. Timing it is another thing. And maybe even foresight is a curse. So talk to me a little bit about the business pressures of being early or calling a bubble, especially in a time of exuberance.
What we found in 98, 99 was that it was far more commercially dangerous to be early getting out of a bull market.
The thing about the underpinnings is they always look terrific. In 1929, the market didn't peak when they thought the underpinnings were terrible. They peaked when the market's enthusiasm for the underpinnings was approximately the highest it had ever been in history. In 2000, in March, the world uniformly, including the boss of the Federal Reserve, Alan Greenspan, they all thought the system had never been better.
Right.
At the top of the housing bubble in 07, Bernanke and the boys thought the US housing market had never declined, unquote. It merely reflected a strong US economy. The underpinnings were great. They have never gotten it right. The Federal Reserve in particular has never had a clue about asset bubbles. It doesn't even address it. They act as if they don't exist, except on the upside, they occasionally take credit for the wealth effect helping the economy along. And it does.
Right.
There is an income effect, and it does help the economy along. And Greenspan, Bernanke, and Yellen all took credit explicitly for helping the economy along. What they never did is they never took discredit for the reverse side. The market is mean reverting mechanism, and eventually it goes back to a fair price. And when it went back in 2001, 2002, it had a dreadful negative income effect. When the housing market collapsed and it took the equity market with it, it had a double-pronged negative effect on the economy. So it had a much bigger impact on the economy than had occurred in 2000. And this time, we're really playing with fire, because this time, unlike 2000, we have an overpriced bond market. Jim Grant would argue the most overpriced in 4,000 years.
Right.
We have, in my opinion, and that of many other bubble students, the most overpriced US equity market in history. We have a housing market that 3 weeks ago reached the same multiple of median family income as it did in 2006 at the peak of the housing bubble. And we have commodities that have recently run amok, so that the Goldman Sachs index of non-energy, which is food and metals, which are pretty important, have just equaled the peak of 2011, which was said to be one of those super cycle commodity events. So
Right.
this is the first time we've ever risked 3.5 asset classes bubbling at the same time. If and when we reach a period of pessimism, the potential unraveling in terms of perceived wealth is much greater this time than it will have ever been before.